Okay, so the following basically just going to be a whole collection of videos and tips for your exam. There won't be any sort of clear order to any of these, so I'll be talking about random concepts from Unit 3, Unit 4, macroeconomics throughout these videos, so don't stress. Basically, the idea of it is just to give you as many tips and tricks and to clear up any areas of confusion and to improve the overall quality of your answers going into the exams. So hopefully there's some things you can take out of this. I suggest you sort of write notes as you watch them and pick up on anything you can. So essentially, starting with monetary policy, something that a lot of people are still doing is when they get something that will increase inflation. So when a question asks you how will the RBA likely to respond to something, basically what you need to be thinking about is how will this impact inflation? If it's likely to increase inflation, they're more likely to tighten monetary policy. But it's really important that given the current monetary policy settings, if you get a question about something that's going to increase inflation moving forward, so that might be if the terms of trade goes up or if unemployment continues to fall or we have a lower Australian dollar, all these things can cause more inflation. Make sure you clearly state that the RBA is more likely to tighten monetary policy and adopt a less expansionary stance. Do not say they will implement a contractionary stance. Given the cash rate's currently at 1.5%, it's very unlikely they're going to push it all the way up to above 3.5%. So always answer these questions with knowledge of what's going on at the moment, and always say they're going to adopt a less expansionary stance if it's going to cause more inflationary pressures. That's tip 1 from this slide. Tip 2, when you get questions on open market operations, so it asks you to go through the process that the RBA takes to either tighten or loosen monetary policy, just a couple of key things you can do to improve the overall depth of your responses. So for example, if you're talking about a loosening of the cash rate, state that the RBA will buy securities, and then rather than just saying it's going to increase liquidity, state that will increase the amount of cash or liquidity in banks' exchange settlement accounts. And then again, you can even explain briefly what that means. So exchange settlement accounts, compulsory accounts held by the RBA to settle interbank transactions. Now, the impact of this liquidity in the bank's ESAs, as we talked about in class, the banks don't want to hold money in these exchange settlement accounts because they know they will earn less interest than if they lend it out in the overnight money market. So the idea is that because they get less interest in holding these money in these exchange settlement accounts, it's 25 basis points lower than the cash rate, they're more likely to lend the money out to other businesses, and that will increase the overall amount of cash in the cash market, which will push the cash rate down and bring it closer to the target cash rate. So you should have started your response by saying that they will lower the target cash rate, but when you're going through the open market operations process, in terms of adding depth to your responses, mention that the money flows into the exchange settlement accounts when the RBA buys securities, therefore they're more willing to lend that money out because they don't want to hold the money in their exchange settlement accounts, and that leads to more cash overall in the cash market. Another key trick that you may get tested on in a multiple choice question, remember that if commercial interest rates change by 25 basis points, for example, that doesn't necessarily signify a loosening or tightening of monetary policy. Okay, the fact that interest rates have gone up this year is not a tightening of monetary policy because the cash rate hasn't changed, it's just commercial interest rates that changed. So be careful about that sort of trick question. Other questions related to monetary policy, the underutilisation rates that are occurring at the moment, because there's still high levels of underutilisation, that means that overall the supply of labour is exceeding demand. That's limiting wage pressures and keeping the monetary policy stance quite loose at the current point in time. How does lower interest rates in the USA impact the effectiveness of monetary policy? This was a question in one of the CPAT papers that people found particularly difficult. The idea with this question is that if the USA were to lower their interest rates, now at the moment they're increasing, so it would be the opposite, but when they lower their interest rates, that can lead to an appreciation of the Australian dollar because we have higher relative interest rates. Now the issue with that is that might limit the effectiveness of an expansionary stance because through the exchange rate channel, it would have less effect. Lower interest rates in Australia would have less effect because the relative rates of interest would stay the same. So it might undermine the exchange rate channel by keeping the Australian dollar higher and therefore limiting the expansionary impacts on demand that we get from a depreciation of the Australian dollar. And how is the RBA likely to respond if inflation is below 2%? Okay, when you get questions like this, a lot of people are saying they want to, increase demand or they want to increase inflation because our goal is 2 to 3%. That's true, but basically it's more relevant to the other things in the charter. So if inflation is below 2%, the RBA is unlikely to be concerned with inflationary pressures and are therefore more likely to be focusing on other goals within the charter. So focus more on how they will be working to try and stimulate growth and stimulate employment and overall economic prosperity, rather than just focusing on getting back to 2 to 3% inflation. Talk about how they gives them scope to focus on the other goals. Okay, so key things, don't say more contractionary stance. more information when you go through open market operations questions. Underutilization is keeping wages down because supply exceeds demand, which is keeping the stance expansionary. Lower interest rates can affect the effectiveness of monetary policy through the exchange rate channel, and talk about the whole charter when you get questions about how they're likely to respond. Point 2, when you're doing questions about factors impacting the Australian dollar, it's really important that you link it to specific things that are specifically in the study guide. So you don't want to be getting, if you get a question like this for 4 marks, you want to have in the back of your mind the 5 things in the study guide and not be floating around trying to think of sort of random things to talk about. So the key things impacting the dollar, the relative rates of inflation. If our inflation is higher compared to other countries, then we'll export less and import more because we're less internationally competitive. That will cause more supply of the dollar and less demand for the dollar, and the dollar will go down. Okay, so relative rates of inflation is one factor. The terms of trade, key things with the terms of trade, state that it's the price of exports at the ratio compared to the price of imports. When the terms of trade is higher, given that the demand for particularly our commodities is inelastic, it means that there's more overall demand because there's a higher value of exports. So we sell a similar quantity at a higher price, therefore they exchange more of their currency into ours, therefore the dollar goes up. Relative interest rates, this is the big one at the moment. Okay, at the moment, Australia's interest rates much lower than the US's, especially as they continue to tighten monetary policy in the US. That's discouraging capital inflow into Australia and encouraging capital outflow. So the key things here is don't talk about putting money into banks. Never say they'll put money in our banks or anything like that. Say that Australians are less likely to invest because of the lower return for Australians of putting money in our banks, we're more likely to invest in securities, for example, overseas, bonds you can pay interest on. We're also more likely to buy shares and things like that because interest rates are so low here, and find better alternative investments overseas. Likewise, Americans are less likely to invest in Australian because they're more likely to essentially invest within America where they can get higher returns. So don't link it to putting money in the bank, but link it to capital inflow and capital outflow. Other factors, exports and imports, relatively straightforward. When we export more, there's more demand for the dollar. When we import more, there's more supply of the dollar. And the last one, capital flows. Capital flows, make sure you know these really clearly. Okay, they're just things in the financial account, never the current account. So never say that exports and imports increase or decrease capital flows. That's not what they are. They're about debt and equity. So capital flows that would depreciate the dollar is if we buy properties overseas, if we buy shares in foreign companies, if we lend money to other countries because they get the money, they are all debits in the financial account. And on the flip side, in terms of things that would cause the dollar to go up, capital flows, if others invest in property, if foreign entities invest in Australian companies, if we borrow money from overseas. So all the credits in the financial account. Make sure you know your factors impacting the dollar really well. Public sector debt, okay, this definition of public sector debt and comparing it to net foreign debt is another thing that you really want to be tight with your language. So public sector debt is the debt of the government, the Australian government, and basically it's the Australian government's total stock of debt to both the private and overseas sector. Okay, so it's money that they owe to banks and companies in Australia, as well as money that they owe to the overseas or financial sector. When you're doing questions related to the budget deficit and public sector debt, always define a budget deficit as the government is spending more than they're earning in a given year. To finance that, they sell securities, okay, or bonds, and that leads to an increase in public sector debt, okay, because they're borrowing from overseas nations or borrowing domestically. In terms of when we're in a when we're in a trough, automatic stabilizers would work to increase the size of the deficit because we'd collect less tax and pay more welfare. Then the government has to borrow through selling securities, which will then increase the size of public sector debt. Okay, in terms of fiscal consolidation and public sector debt, again, make sure your language is really clear. Define public sector debt and talk about how fiscal consolidation before 2021 is likely to lead to a smaller increase in public sector debt, as we don't need to issue as many securities, because even though we're in a deficit and our debt's still growing, it's not as big, so we're not issuing as many securities. Then as we reach surpluses, we can start paying off the debt because revenue is exceeding expenditure. That language and linking it to public sector debt, being able to interpret graphs, is really key when you're doing these questions. And finally, budget deficits don't always increase net foreign debt. Because we can finance budget deficits by borrowing domestically, they will always increase public sector debt because that includes the government's debt to the private sector. They don't have to increase net foreign debt because net foreign debt only increases when we borrow overseas. Okay, and the government has the option of borrowing from Australian entities. Some Australian entities have got heaps of cash that they can lend to the government that would not increase net foreign debt. Policies for fiscal consolidation, make sure you know these really well. Couple of key things. With the HEX repayments, there's two components to that. Well, there's actually three really you could link it to. One, they're lowering the threshold that you have to pay it back. It's gone from around 55,000 to 45,000, so people will be paying it back quicker. They've increased the student contribution amount, so students have to now pay around 7% more of their uni, so basically that means the government's got to be funding less of people's universities' fees. And they've also increased the rates you have to pay it back by. So, for example, if you're a really high income earner, about 10% of your income has to go back into your HEX as opposed to 8%. So they're going to be getting the money back off quicker of high income earners as well. So there are three different things. They've lowered the amount you can earn before having to pay it back. They've increased the student contribution amount. And they're making high income earners particularly pay more back. Welfare reforms, okay, that can include all range of things. Increasing the waiting period for for immigrants for another year to get their welfare would be one of the key ones, and then all the stuff related to the job compliance framework, getting people off drugs that are on welfare, people that have indictable offences, making it hard for them to get welfare and things like that. Data matching, okay, making sure that if people are working that they're claiming the right amount so they're not getting too much off the government, and the crackdown on the black economy is related to those purchases over $10,000, not allowing them to pay for it in cash. Right, analysing the performance of the Australian economy in terms of jobs and growth. Okay, really important thing was in last year's exam. It's probably going to come up again. It's really important you have a really clear understanding of exactly what's going on in terms of unemployment at the moment and in terms of the strength of the economy when we're looking at growth. So basically, things have improved this year. Full employment's improved, strong and sustainable growth's improved. As of the September quarter, technically we're meeting both goals. Growth's at 3.4%, unemployment's at 5%. Make sure when you do these questions you make it clear what the goals are, even though if it's not implicit, so that you show what we're aiming to achieve. Always good to define NIRO when you're talking about the goal of full employment, so the non-accelerating inflation rate of unemployment. We're trending quite well because unemployment's down to 5%. Employment growth has been strong. That's really important. The amount of jobs created has been really high this year and even more so last year. Participation has increased. Underemployment and underutilisation have both fallen. So this is all indicates that the labour market has gotten stronger. However, we are still in a situation where wage pressures have remained quite low. So what we expect, because there's still 8.3% has gone down, that's still a lot of underemployment. So given the higher levels of spare capacity in the labour market, it's really, our unemployment rate really has to be at around 4%, even 3.5% before any sort of inflationary pressures start to be experienced, and before the government will really start to look at, not the government, businesses will start to really look at increasing their wages. So they're the key things in the labour market. Talking about how it's getting stronger, but there is still scope for improvement. There's still a lot of spare capacity. Wage pressures are still low. In terms of growth, growth has been strong at around 3.4%. Define what we're trying to achieve. The main reasons for that, though, have been mainly demand-side factors. So lower household savings, stronger overseas growth has been really important, and the lower dollar are all stimulating aggregate demand. But from a negative perspective, there's arguments that because a lot of our growth has been demand-driven, it may not be sustainable. So given productivity growth remains weak, we're really relying on demand-side factors, with the exception perhaps of participation increasing, to stimulate that growth. So we really need to look for other ways that we can stimulate growth that are more supply going forward. So more generally talking about growth, we've experienced strong economic growth. Key things, consumption's increased, net exports, even non-mining investment, I'll say that again, non-mining investment has improved this year. That's a really key thing, which has started to boost investment spending. They're mainly short-term demand-side factors, overseas growth, lower household savings, consumer confidence at the start of the year, low Australian dollar have all helped, as well as the low interest rates, which stimulate demand as well. Productivity growth will need to improve in the future, though, if we're going to continue to ensure sustainable growth levels. So it's really important that you focus on that in your answers. We'll talk about this in the next video. Thank you.